Okay, everyone, hedging. This is a strategy I'm going to share with you, which has massively helped my trading personally. Let's say I'm in a trade and I'm in a profit. I don't want to close a trade because I think it may go in my favor. I don't want to give up the profits that I've made because the market may go against me. I'm not quite sure what's going to happen next in the markets because we have to wait for economic data to come out. Maybe I want to go on holiday and I don't want to be looking at my phone the whole time on my way. And I really want to find a way to be able to just leave the trade open, but not have to worry about losing money, for an example, and not have to worry about me watching the market every day to make sure that I have to take a profit. So hedging is a perfect way to minimize this risk of losing money and having to stay on the phone all the time. Also, if you're in a trade and let's say the trade's gone against you and you don't want to close the trade, you still really believe the trade may go in your favor, how do you have a strategy that can allow you to basically just watch the markets, and even if the markets went against you even more, you could actually have a position on that can make money on the way down, right? So you wouldn't lose any more money, you'd make money on the way down, but you would only cap the loss that you currently are in at this moment in time before you put this hedging strategy on. Once you learn hedging, I promise you, you can go on holiday. You can literally not even look at a trade. You will not lose any more than you're already losing in a trade. Or if you're in a profit, you will not lose your profits. You will not make any more, but the trade will just remain exactly where it is. I promise you, it will give you peace of mind to maybe have a break from trading, go on holiday, wait for some economic data to come out, and you will be relaxed because hedging is a strategy which all the professionals use, hence the term hedge funds, okay? And you're gonna learn how these professionals use a strategy. You can apply this to crypto, to Forex, to stock markets, to commodities trading. It literally works in all the markets. So I really hope you enjoyed this video. If it does add some value to your trading, please let me know, write me a comment, please like, comment, and subscribe, and enjoy this video on hedging. Okay, everyone, warm welcome to this video. We're gonna talk about hedging. This strategy is going to make sure that you can sleep well at night and make sure that you can lock in the profits that you're in. If you're in a trade that's going in your favor and you don't want to close the trade, you believe the trade may still go in your favor, but you're worried about the market going against you and hitting a stop loss, which you may have had if you've rolled in some of your profits, for an example. Or on the flip side, if you're in a trade and the trade's going against you, you're losing, you still believe the trade may go in your favor, but you're afraid of losing more than you already lost. Maybe the trade's right next to your stop loss, but you have a real belief that it may turn around. I'm going to show you how to enter a trade that locks in either your profits or locks in your loss. And it doesn't matter how much the market moves until you're confident enough to take off that hedge and then be able to continue to trade in the direction which you want to trade, okay? This is going to give you the peace of mind to know that you can no longer lose more than you're already losing, or you can no longer make more than you're already making, but you won't have to close a trade if you're in a good profit. Okay, so we're going to give you this example in Euro USD, but this can literally work with any asset that you're trading, whether we're talking currencies, crypto, stock markets, or commodities. Okay, so let's walk through this example if we're looking at trading the Euro USD exchange rate. Now remember, if you're trading currencies, the certain amount of units that you're trading, also known as a lot size, is going to determine how much the market goes in your favor per point, for an example, or against you. So let's say you're trading Euro USD. If you're trading 100,000 unit lot size, that's equal to $10 per point. Okay, so if the market goes in your favor by 100 points, obviously you're going to make a really good profit of $1,000, for an example. Or if the market went against you by 100 points, you could lose $1,000. Okay, it's all dependent on how much risk you want to take. But let me just break through how to use the strategy to your advantage. Okay, so let's say we are looking at buying Euro USD, and let's say you're taking a position of 10,000 units, which is equal to $1 per point. Okay, let's say that you entered the market at 104, which would be right here. You got into the trade at 104, and now the market has risen to 107. So it's gone up 300 points in your favor. Now remember, if you're taking a trade of 10,000 units, that's equal to $1 per point. So you would be in a profit of $300. Now let's say something is happening, some economic data is coming out. Let's say you're going on holiday and you don't want to close the trade because you still believe the trade may go in your favor. And let's say you have a target of the market going up even more, to 110, for an example. So you don't want to close it because you may make an extra $300 profit, but you also don't want to run the risk of the market dropping against you and you giving up all of your profits. How could you make sure that whilst you're on holiday and you don't really want to be looking at the computer screen all day, that you lock in that $300 profit? And even if the market dropped, you don't lose anything. But if the market goes up, you don't make anything, but you've locked in that profit. So when you come back from a holiday or when you're ready to start trading again, you can take off the hedge and then you can continue where you left off with your $300 profit, okay? So let's give this example. So the market's gone from 104 to 107. You've made $300 profit. What would you do to lock in that profit, to give you the peace of mind to go away, not look at the computer screen and come back with the same amount of profit? Well, it's really simple. All you would do at that moment, you would enter into a sell position at 107 with the same lot size as your original position, okay, of 10,000 units, which would be, again, for every time the market goes in your favor or against you in terms of going lower, you would make or lose $1 per point. So my point being, if you sold the exact same position, which is equal to your original trade at 107, and now the market dropped by 300 points and went down to 104, what would happen? Well, it's really simple, guys. All that would happen is that you would lose $300 on the trade that you've already made your $300 in, but because you've now entered into a sell position and the market goes down by 300 points, what happens? You make $300. So you've locked in that $300 profit because that's what you're starting with. And this really gives you the peace of mind to know that even if the market drops by 300 points, I'm still gonna make 300 points on the sell position whilst my original position loses 300 points and I lose my $300. So I've basically made the $300 on the way down, but I've lost my original $300. So I'm still in $300 profit. Do you see how this can really help you when you're in a trade and you're not sure what to do if you don't want to close a trade where you're making money? This is a perfect example of hedging your position. All you simply do is you take off the stop loss from your original position. So take it off. You're now in $300 profit. Take a sell position with no stop loss, because if it drops by 300 points, you've made $300 and you've lost your original $300. So you're still at $300. If the market was to go up in your favor by another $300 to 110, you wouldn't make that $300 because the sell position that you've entered is going to lose $300 at the same time. But guess what? You're still in $300 profit. Do you see how hedging can really give you the peace of mind to go away, come back, or if, say for an example, some economic data is coming out and you're not really sure how the market's going to react, you can just enter this trade to protect you until you have a clearer observation of where the markets may go next. And once you know where the markets may go next, then you could take off the hedge. So in this position, if it went to 110 and you believed it was going to keep going higher, you would then take off the sell position and you'd still be in $300 profit. Okay, so this is a really good way to hedge a position when you're in a profit. Okay, so let's take the complete reverse situation to make sure that we can protect our accounts from a losing trade that you may not want to close because you still believe the market may go in your favor, but you don't want to lose any more than you're already losing. Okay, so what you could do, let's say you enter the market at 110 Euro USD in a buy position, but the market went against you and it dropped down to 107. So you're down 300 points. And again, if you're taking a unit size of 10,000 units, you've lost $300. So you're down $300, but you still believe the market may go higher. What could you do to make sure that you just lock in that $300 loss, even if the market dropped by another 1,000 points or pips, and you lost another $1,000? How could you make sure that you could make $1,000 on the way down, so you would literally net still be losing only $300? Well, you would do exactly the same as in the first example. What you would do is you would just enter into a sell position with the same unit size, so you're making as much money on the way down as $1 per point. So let's say now the market goes from 107 and it was to drop, for an example, by another 500 points. So usually, right in this situation, you'd be down, say, $800. But because you've now entered into a sell position and the market goes down by 500 pips, you've made $500 on the sell position. Okay, so you've again locked in your loss at $300. The market could literally go down, it could keep going down, but your sell position from the price that you entered is going to make as much profit as the position you have, which is a buy, and it's going to make your account go down. So it just basically locks in a loss of $300, and that gives you the peace of mind that even if you get a big swing lower and then another leg higher, during that swing lower, you've locked in your loss at $300. So let's say it goes down to 102 for an example, and then it turns around and goes all the way back up. Once it gets back to this position, or let's say it goes all the way up to 110, and this position now is in no loss. Okay, so you're at break even at this trade, but you're in a 300-point loss in that trade. Well, what's the difference? You're still only down $300. And at that time, if you really believed the market was going to keep going higher, you could take off the sell position and you're still only down $300 from the trade that you closed. Okay, so you can see how you could protect a losing trade from losing any more, but at least you can give yourself the chance that if the market rebounds, you don't have to lock in that loss. You can take off that hedge and you're still only going to be down by the $300 you was down when you decided to put the hedge on. So the key takeaway from this strategy is to remember that when you're ready to take off your hedge, whether that's to lock in your profit or lock in a loss, when you take off the hedge, if you want to keep the trade going in your favor, you could just re-enter the same stop loss that you had, and then you can wait for the market to go in your favor. Or if you just wanted to get out of the trade completely, in that example where the market was down, for an example, by 800 points or pips, which means the same thing, okay? Because you've made $500 on the way down, you'd still only be down $300, and you could take off both trades. And again, you're only going to lose the $300 that you was originally losing if you recognize that the trade has completely gone against you. Or you may be able to just keep the sell position open and have a bet that you're going to make money now on the way down. So it gives you real flexibility when you're trading to make sure that you can protect profits, you can lock in losses, but it gives you the freedom to be able to relax, let the market do what it does, because as you know, markets can be very irrational, economic data can go against you, or something can fundamentally happen that can move a trade against you in the short term. All right, so I hope this video added some value. Please like, comment, and subscribe to my YouTube channel, and I'll keep posting content. Thank you.